Welcome to the daily update, where I'll go over the action in the market for Thursday, March 20th, and we'll see how things look for Friday, March 21st. Well, let's see. The futures overnight were looking kind of positive, up about 0.5%, and then things really started to drift lower. We actually went negative about 0.5%, and so that produced a lower open in Thursday's session. But then we immediately saw some buying come in, and that took us back positive. But that didn't last very long. And then we ended up coming back down, being negative, and actually closing down for the day. So we're not seeing any real follow through after this nice little bounce that we saw on Wednesday after the Fed made their announcement that they weren't changing rates and about the economy and other such things. But we're still seeing some subtle improvements under the surface with some of our indicators. Now, if we have a solid down day, that could wipe all those out quickly. We're not really seeing much of a change when we look at growth versus value. Those areas are just not improving, but they're not falling apart at the same time. But some of our momentum indicators in the short term, they're actually starting to switch back positive. We're seeing an improvement in the intermediate term. So there's some positive things under the surface, but there just seems to be this lack of conviction where the market, on one hand, you could say it's getting more defensive, getting ready to go down, or on the other hand, at least growth is holding up, which that could be added to help the market to really go up. Okay, so right at the open, we had a lower open. Then we immediately saw some buying come in because there's a lot of these folks that implement this buy the dip thing. We climbed above the daily pivot at 56.71. We got above the unchanged level, so then we went positive, and then we even got above 5,700. And then we hit resistance at yesterday's high, just a little bit above 5,700. We couldn't get above that. Then after that, we started to decline. We went back down below the unchanged level. That took things negative. We went below the daily pivot. We found support at the 56.50 level, and then we closed slightly below the daily pivot. So we bounced up just a little bit going into the close. We were down 0.22% on below average volume. That seems to be what even if we have an up day or a down day, we're seeing below average volume right now. And we are still negative in the short and intermediate term because of the moving averages. We're mixed in the long term since we're still underneath the 200-day moving average. Interest rates came down a bit, but they were much lower right at the open. But then they ended up inching their way back up. And we had some economic reports that I'll go through. And a lot of this is Doge and executive orders and trade wars and tariff concerns. And there's a lot for the market to digest right now. So, some comments. There were other banks outside the US that made rate announcements. Most of them were unchanged. China, Sweden, and the Bank of England, they didn't do anything with their rates. The Swiss bank actually cut rates, and Brazil ended up raising rates. Then, in the European Central Bank, their president suggested the 25% tariff on imports that is being imposed by the US could subtract about zero point 0.3 percentage points from euro area growth in the first year. Okay. And then mega caps, that we didn't see any follow through there. We saw some strength on Wednesday with the mega caps. Didn't really see that in Thursday's session. The VIX is still under 20. Now, it went back above when we had the lower open, but by the time we closed, we're at 19.8. That's still a high reading, but at least it's under that 20 level. And then on an extreme positive basis, we have the Stochk RSI. That's picking up a little bit of momentum to the upside, but we're not really seeing that confirmed by other indicators. In the short term, we still have an oversold list. Now, the ADX, that's giving us a high reading, and because I have it on the oversold side, because the trend is down right now, and just the long-term stochastic, but even it's trying to turn up. The rate of change going back 20 periods, and then the slope oscillator, which has actually turned positive now. It's crossed above its moving average, but it's still giving us an extreme negative reading. And we just have the TTM squeeze in the intermediate term, but you could also make a case that that is positive because it's the lighter shade of red and it's coming up. We still have a non-confirmed Hindenburg Omen, We have until March 31st for another spike in that chart. Until then, it's not considered to be confirmed. All right, no changes to the overall scenario. The Fed has lowered their growth expectations. They've raised their inflation expectations, and they said we're not going to do anything with rates for right now. The dollar was up and interest rates were down. We're at 4.23% with the 10-year yield, where after Wednesday, we were at 4.26%. We didn't change as far as sentiment. We're still coming in well under that 25 level that we usually just come down and bounce out of, but we're camped down below 25, and we have been. It's coming in at 22, which is the same reading we had after Wednesday. We're still inverted with the 10 to the 3-month yield curve. Just keeping an eye on that for right now. And we're still dealing with a negative trend. The ADX, it's weakening, it's rolling over, but it hasn't quite crossed below its moving average. Now, that doesn't mean that we're going to turn and go down or turn and go up. That just means the strength of the trend is starting to go away. And that could mean possibly that this downward move that we had been seeing, it's starting to exhaust itself, especially as we've been trying to bounce back up from this recent decline. And because of the down day, our bias is negative. I'm still keeping our momentum at mixed. Things are showing some improvement, but it's a very vulnerable market at the same time. The economic reports that came out, we had jobless claims came in a little bit more than expected, but still not all that different at 223,000. They expected 220,000. Continuing claims came in at 1.892 million, and I have a chart of this to show you. I don't have a chart of this. The current account balance minus 303.9 billion. That's less than the minus 334 billion they had expected, and also down from the 310.3 billion that came out last time. The Philadelphia Fed index, it was lower than before, but higher than expected. It came in at 12.5. And then the dividing line between expansion and contraction is 0. So they're seeing a little bit of expansion in the Philadelphia area. Existing home sales up 4.2% on a month-over-month basis. When you adjust that annually, that's 4.26 million. That's greater than the 3.95 million. So that's actually a stronger than expected report there, where last time it adjusted on an annual basis to 4.09 million. Sales were down 1.2% from the same period a year ago. The leading indicators came in down 0.3%. They expected it to be down 0.2%. Last time it was down 0.2%. Okay, so some charts here. These are weekly jobless claims where it is going back up a little bit, but you can see we're still within this range overall. It's not really showing a lot of weakness in the employment arena. And that's what we're going to be keeping an eye on. If we see employment really start to take a hit, that could mean a recession is more likely. But as long as this is holding up, that's why the Fed has been justifying not doing anything with rates. It's why they justified keeping rates higher for longer, because the employment situation has been holding up. And here are the continuing claims, which did increase in the latest reading, and we're going up with the 4-week moving average. This also plots those same two lines in blue and red, but here we have the latest reading of the unemployment rate at 4.1%. Here's the Philadelphia Fed manufacturing index, where it's positive, but it's really been coming down lately. So it's still showing some expansion, but not as much as we were seeing before. And then here's the LEI. This is leading economic index. It declined for the third consecutive month in the latest reading. Now, there are some forward-looking parts of this particular reading, and that's really what we focus on here. That's the black line going up. There are some backward-looking things that are used in this calculation. The things that are more for right now, that's the blue line. It's called the coincident economic index. And that's actually been declining, but the one the market tends to focus on more is the black line. But then when we look at the next chart, we look at this, the 6-month growth rate. It remains in an upward trend, but weakness among the components triggered the warning signal. Okay, there's some inside of this report there is showing some weakness, but the blue line here is still going up, and we're above this red line. When we drop down below the red line, that's the recession signal. Then looking here, annual versus intra-year returns. This goes back to 1980, and it just says, okay, we ended up having what were we up on the positive side and what were we down on the negative side. And then we look at the year to date over here for 2025, where we're down on the year, and we did go down that 10% for the correction. So far, we've been able to stay above that. We're about 8% or so below that all-time high. But if we see more weakness, we could go back into that correction territory. That's what we're trying to see is, are things improving enough to take us back up and get us further away from that 10% correction level? Then stocks rarely peak in February. Well, yeah, because that's when we set the last all-time high. And we go back to 1950. Well, that happened twice. So it has happened. Never happened in June. But it just says usually it's in December when things top out. We did set an all-time high in December, but then we set another one back in February. So they're just saying that February is from a probability perspective, that's not the time when stocks usually top. Okay, U.S. equity saw retail outflows in the last 2 weeks. Gee, you think? The market goes down, people start flocking to the doors and start pulling their money out. Then the S&P 500 returns during different GDP environments, and it only goes to reason. When we have positive GDP, the market does better. When we have negative GDP, the market doesn't do as well. And we're right around in here. It depends on the forecast. Now, the Atlanta GDP now forecast has us negative, which that's concerning the market. But the New York Fed forecast, they have it positive at around 2.6%. So that's actually more positive for things. And the more positive the GDP, at least on a growth basis here, the better it tends to be, unless it's below zero. Not sure what they're getting with on that one. Then this can be kind of a hard chart. If you see the red area in here, the 10% correction that we saw was one of the fastest, and that's just ranking it amongst other declines. Usually they take a lot longer for that to happen, but this one was really pretty quick. Then our US FCI impulse now implies a slight growth drag in 2025 following recent tightening in financial conditions. Okay. So it's kind of going along the same lines of other economic reports that things are slowing down. They're concerned about the tariffs. They're wondering what it's going to do to the economy. And then tariff impact on a year-over-year basis, how's that going to impact GDP? Feel free to pause this and look at this because to me, this is all just speculation here. But it says Goldman Sachs forecasts that tariffs will reduce GDP by about zero point 0.8 percentage points over the next year, with tax cuts and regulatories easing off, only offsetting zero point 0.1 to 0.2%. Okay. So that's somehow created that's the conclusion from this picture here. Market implied US recession probability. I look more at the average here because these are mortgage-backed securities and what are the bonds telling us? What's the VIX telling us? They use all of this together. And within the next year, they say there's a 20% chance. And that now there's some folks that think that eventually these numbers are going to be recalculated and it might show that we're already in a recession. That has happened before. We'll have to see if something like that actually plays out. And then down here, being in a recession, it's only at 6%. Okay, it posts this. We had a good update on Wednesday, and Bloomberg put out a chart just saying, okay, it was a good day. All right, then looking at our intraday chart, we did have a lower open, but then we were able to come back and climb above the daily pivot and unchanged level and see how we pretty much matched up with the previous day's high. This was the little spike up that we saw right after the Fed came out with their announcement and press conference. But that was it. We were able to get above 5,700, but then we just started going down. We dropped below the unchanged level, below the daily pivot. We came down to this 5650 level and then bounced up a little bit here and then closed right under the daily pivot. Not an awful lot of conviction. I mean, this was more orderly here, So there was some selling going on, but we weren't really breaking out. We didn't exceed yesterday's high or even the low. And then things are kind of quiet right now in the initial overnight session. And we're still seeing the red line above the blue line. That means that on an intraday basis, value is outperforming growth. Now they're both kind of going up here, and that's good in and of itself, but we want to see the blue line above the red line. And we're not really seeing much in the way of improvement, but we're not seeing a breakdown either with the growth to value ratio intraday for the S&P. So looking at the end of day charts, so growth was down a little bit less than value. It was also down, actually down a little bit more. It was down more for the mid caps and down more for the small caps. It was not a good day for growth. And we can see that reflected in our end of day charts here with the small cap growth to value ratio. Mid caps are up a little bit, but still dealing with the 200-day moving average with this ratio. And we tick down and we're just chopping along sideways with the S&P growth to value ratio. Still below the rainbow with our growth versus value ratio with these two ETFs. And no big improvement. We're trying to come up off the 200-day moving average with the discretionary to staples ratio. And this is where we're potentially rolling over. We haven't quite crossed below the moving average. Now, it doesn't mean necessarily a change in trend. It just means that this was a pretty strong trend. And that's what the ADX does. It measures the strength of the trend, even though we were coming down. It doesn't measure direction. That's what we use the red lines and the green lines for. But this rolling over, and if we drop below the moving average, then that means the trend is weakening. And sometimes when there's a weakening trend, that could suggest a switch to the other side. Since we were coming down during the strong trend, if it's a weakening trend, possibly we could switch to an uptrend because this is not really a bad looking chart right now. For the most part, now it's pretty short, very short term, but we have a series of higher highs. We didn't exceed the high in Thursday's session, but we're seeing a series of higher lows here. And that's looking okay. But this could quickly morph into something bad and we could just drop down from here. But as far as the trend, this could be getting to a point where it's weakening, but it's still trending. We've already dropped below the moving average in the short term. So we'll see if that has much of an impact there. And we continue to be below average with volume for the last number of days. This red histogram down here, that just means for the S&P, the volume was below average. And we're coming down, a little bit of fears getting worked off here with the Ulcer Index. This is kind of like the VIX, but for mutual funds. And we're just a little bit below 20 with the VIX on the line chart as well as the bar chart, dropping with the VIX of the VIX as the VIX itself has been coming down. The momentum of the VIX continues to be down as measured by the MACD. We did get the latest reading. Now we're 4 weeks. Individual investors are extreme negative. This is very rare for this to happen. Usually they come down, everybody freaks out, and we bounce up out of that. We've been camped down here with an extreme negative reading for the fourth time now. Ticked up a little bit with the fear gauge on this chart, as well as a little bit of a tick up on the other fear gauge since we had the slight down day. Going back up slightly with the equity put call ratio daily chart, but we're still really coming down with the 5-day chart and even slightly coming down with the 10-day chart. We're dropping below the band and going down here with volatility risk premium. So now we're with the number of different gauges, we're actually seeing some fear coming out of the market, especially when the VIX drops under 20. That could be pretty influential. Now, the advanced decline line continues to hold up, not showing any real strength, but not showing any weakness. We're just kind of going sideways here, seeing a little bit of an improvement overall with volume because we've seen volume coming out of the mega caps, going more into value, and that produces less volume because they're smaller stocks, the value stocks. Still slightly above zero here with the advancers decliners over the last 10-day period, starting to turn back up. We're seeing a little bit of an improvement here with the new highs versus new lows. So the 5 days going up and we're starting to go up with the 10-day. So internally, we're seeing some improvements here. And we're still above the midpoint, both with the short and intermediate term advanced decline ratio. That's the red and the blue lines. Still slightly above the moving average here with the accumulation distribution. This is smart money indicator number 1, which is still positive, but with smart money indicator number 2, we are negative, and we're just chopping around right about at the midpoint with smart money indicator number 3. No real conviction being shown here. Negative with the vortex, but the red line's coming down and the green line's going up. We're still above the moving average with the advanced decline study here for the S&P, but still below it for the NYSE common stock, mid caps, and small caps. And still below 50. So we're still negative with those stocks in the S&P above their 20 period moving averages. Same thing with the 100 period moving average study, and I got this in the wrong order. Same thing with the 50 period moving average study and then the 200 period moving average study. And see where volume is just really dropping off here as we've been below the 200-day moving average for the S&P. The rate of change going back 20 periods to me is more short term, but we're coming down and getting an extreme reading, and we've been down here for a while now. You can see when we had that really big down day last summer, this actually bottomed right about the time that we bottomed with price, and then we were able to bounce up out of that. That's why I'm keeping an eye on this chart to see if we see something similar this time. And a little bit of a tick down with the 20, 50, and 200 period moving averages. This is the extreme positive reading with the Stochk RSI. That's showing good short-term momentum. But we're not seeing that confirmed by the Williams percent R, the CCI 14, or the CCI 20. Force index continues to be below zero. That's negative, and we're not extreme in the short or intermediate term stochastics. We're turning up, but we're still just barely extreme negative with the long short term stochastic. And looking at the condition of the short term trend measured by 20 periods, we are starting to turn up. That's showing a little bit of improvement. And we're in the -1 channel now with our standard deviations chart. The balance of power still negative, but it had been improving. It ticked down on Thursday. The go no go switched from dark purple, deep purple, to more of a lighter purple. So that's turning a little more positive, but it's still not positive. Bouncing up still from the lowest low value chart, but we haven't even come back up to the midpoint yet. This is the TTM squeeze where it's still extreme negative since it's below this black line, but it's a lighter shade of red and it's going up. So you could make a case that's even positive now. Really coming down with the standard deviation over the last 10 periods because we're getting the lower end of the decline numbers and then the bounce numbers all included, and that really sends the standard deviation down. Improving but negative with the ease of movement. We're negative with the Arun indicator. We're below zero with the oscillator. Still above 50 with the S&P McClellan oscillator. So that's positive. And we're still going up with the summation index based on price and volume. That's positive. And we're still above zero with the NYSE McClellan oscillator. So that's positive. Starting to tick back up with the summation index for the NYSE based on price and volume. And we're still looking pretty good here. The Swindlen Trading Oscillator above zero and advancing based on price and volume. Turning back up, but still negative with the PMO after getting a real extreme negative reading. Turning back up based on price. We've actually already crossed above the moving average based on volume. So that's some of the internal improvements that we're seeing right now. And right about at the midpoint with the PMOs that are rising, we are seeing the buy signals inside of the S&P start to improve, but we're still flat with the PMOs that are above zero. The condition of the intermediate term trend, not back up, at least to the blue line. We're trying to deal with the red line here. And as long as we stay below both of these lines will continue to go down. We're below all the plotted moving averages, and you can see the moving averages are really falling, and even they're in danger of falling below the 200-day moving average. And we're still dealing with overhead resistance with this anchored moving average, this light blue one here. We just cannot seem to get above that. We're neutral with the Elder's Impulse system for the S&P, but we're positive with the parabolic SAR. We're turning back up. You could almost make a case that we're positive with our short-term oscillator, the slope. Even though it's extreme negative, it'll be extreme until we get back up to this red line. But the fact that we're turning up and above the moving average could be taken as positive. We're turning up with the MACD, but we have not crossed the moving average yet. So in the short term, we're actually turning more positive on the momentum basis, improving but not positive in the intermediate term, where we're still going down in the long term. We're crossing over positive with the Copic curve. So that's another part of the improvement that we're seeing. The Sean trend meter, after being extreme negative, is out of that extreme territory, but now we're going sideways. We're still below 50 with the money flow, and we're just barely above 50 with the ultimate oscillator. We're still below the moving average with unbalanced volume, so that's more negative. We're still below 50 with the RSI 14 and 9. That is also negative, but we're still positive here with the bullish percent index. It continues to go up. It will be confirmed positive if we go above 50, but the fact that it's green above the moving average and going up is positive. And we're looking better here with the NYSE bullish percent index, but we ticked down slightly with the NASDAQ 100 bullish percent index. We're still waiting to see if the mass index falls below this red dashed line. That might mean that the market will have a reversal. Then we're still dealing with this 61.8% retracement level. We cannot seem to get above that, but we're still holding above the 50% Fibonacci retracement level here. So if we break out, that'll be positive. If we break down, that's naturally going to be more negative. We're still holding above support, above this pivot point, and that is positive. And this is a weekly chart. So after Friday's session, this bar will complete. And if we stay above it in Friday's session, we'll have 2 weeks where we fell below it during the week, but we were able to close above it. That means longer term, this support would be holding. If we close down below it, yeah, naturally, that's going to make things more negative. Showing some improvement here with the Heikin Ashi, turning back more positive. We're positive with the Kegi chart, but we're still negative with the Renko chart and the three-line break chart. So getting a mixed picture there. Long term, still seeing some improvement here with the 150 and 200 period moving averages. And no changes here, still negative in the short and intermediate term with all the different stock indexes. And no changes here. Bonds are still positive in the short and intermediate term. Commodities are positive across all time frames. And the dollar is still negative in the short and intermediate term. And we're kind of split as far as the sectors, but it was more the defensive areas that did better. Utilities, energy, we're glad the financials are doing better. And then healthcare, that's defensive. But you see, tech, it led things to the downside. Discretionary and communication, they were all down. These are the three big growth areas. And saw some blue to start the day with the discretionary BPI cross above 20 because it had been really beaten down lately. So it's starting to come back up. And then we got below 17.7 with the NASDAQ, and then we went above 17.8, 17.9. This is when the S&P got above 5,700, but we can't seem to stay above that right now. And we're coming up right to the underside of the 200-day moving average with the Dow. That could be acting as overhead resistance. We're neutral with the Elder's Impulse system for the diamonds. Still just kind of chopping around right now with the NASDAQ and the NASDAQ 100. We're neutral with the QQQs with the Elder's Impulse system. The momentum is improving for the NASDAQ 100, but for right now, it's still negative. And we're seeing a recent death cross here with the small caps. This is the S&P 600. Not quite there yet with the Russell 2000 small cap index, but it's getting close. And we're going from positive to neutral with the small caps with the Elder's Impulse system. A little further away with the mid caps, but they're under pressure lately now too. And they've gone from positive to neutral with the Elder's Impulse system. Still below the 50-day moving average of the financial sector, even though it was up slightly. So that's encouraging. But we're now back just a little bit below the 200-day moving average with the bank ETF. And so I've been keeping an eye on this. We want to keep an eye on the financial sector with economic things possibly in the background and tariffs and interest rates, and just want to watch that area. The Wilshire 5000 broad market measure is still below its 200-day moving average. We're still below the 200-day moving average with the total US stock ETF, and still tending to come down here, even though we're just about getting ready to see a golden cross with this ratio. But when this is coming down, that's actually positive for the S&P. That means staples are underperforming the tech sector. And we're right a little bit under the moving. This is very similar to the bank ETF. We get a little bit above the 200-day moving average and now a little bit below when we look at the FANG index. And these are the mega caps, the real big companies. Apple ended up being up 0.5%, but still below its 200-day moving average. Coming back up to the 200-day moving average with Amazon, but then that's acting as overhead resistance and it came down from there. Microsoft is in a downtrend. Google also under its 200-day moving average. Meta trying to bounce up off of its 200-day moving average. Nvidia seeing a death cross here. That's a longer term downtrend, and it's still below, and it was actually up 0.86%, but it's going to need to do a lot better. Tesla was virtually unchanged, still below its 200-day moving average. Netflix was down almost a percent, still about at its 50-day moving average. And not seeing much changes here when we look at US to world stocks, staying about the same on a short-term basis, but seeing a little bit of weakness here with the longer-term correlation. Oil did drop back down into the 60s after it had climbed back up into the 70s. And the dollar is just kind of bouncing around. Not a lot of movement right now, not an awful lot of conviction. So coming down a little bit here with the 10-year yield, going up with the 10-year based on price, but closing well off of the highs here. And we're still slightly into this red area with the 10 to the 3-month yield curve. So that's inverted. Still not seeing really any improvement here with our growth to value ratios. When we look at the Qs to S&P, discretionary to S&P, large cap growth versus large cap value, still seeing weakness here with the large caps, mid caps, and small caps. And still going down. This could be negative here because the S&P is underperforming utilities. So this ratio is actually going down. But this could be positive. We see the staples to S&P. We spiked up and we're starting to come back down. If this continues to fall, that might be more positive since when this is going up, that means staples are outperforming and staples are more defensive. That's what the market gets into when it's going down. So what's our outlook for Friday? Still negative in the short and intermediate term, still below the 200-day moving average. So far, long-term support is holding. We are seeing some improvements, but a solid down day and all those improvements could be wiped out. We're not going to have any economic reports on Friday, and then all the different geopolitical things just to see what develops there with Russia, Ukraine, with the potential ceasefire, what's happening in Israel, all the stuff happening within the US with all the different changes that are taking place. No economic reports and nothing to show here. Seasonally, we're neutral to negative. It's not a really good day for March 21st. The Dow and the Nasdaq are neutral to negative, where the S&P is just downright negative. We will be finishing out options expiration. Friday will be options expiration day. And so that can be a weird day. That's like a day in and of itself, kind of like a Fed day, where you just kind of step back and say, okay, these are one of those crazy days where the market acts weird. Options expiration, and this is the end of the quarter. So this is what we call quadruple witching. There are four kinds of different options that are all expiring at the same time. So it could be pretty hefty, and we could see a real pickup in volume. And seasonality, when you look at the solid lines here, we look pretty good for the next few days. But in a post-election year, typically we see some weakness for the next few days. Still hoping that the second half of March will be more positive than the first half of March. And this is kind of showing seasonally as we play things out until we get into the spring. All right, so we're still seeing a mixed picture here with our smart money indicators. We're above the moving average with accumulation distribution, but we're going down with the Chaikin money flow, and we're just chopping around to slightly declining with the Chaikin oscillator. The bullish percent indexes for the NYSE and NYSE, they're doing okay. They're showing some improvement where the S&P is actually positive, but they're negative because they're still below 50. That's why they're on this slide. Now we're seeing a bit of a shift here with our oscillators. We're turning positive in the short term. They're improving in the intermediate term, where they're still negative in the long term. And then we have this long-term special K oscillator that is negative. The moving average studies still below 50 with all of the studies that we look at. The ease of movement, money flow are negative. The vortex is negative, although it's improving. And we're improving with the momentum for the NASDAQ 100, but it's still negative for right now. And then we're still seeing longer term uptrends with our growth to value ratios as well as discretionary to staples. But so far in 2025, they've really struggled and they're down around their 200-day moving average with that particular trend. The equity put call ratios are going down. That could be positive. And the S&P and NYSE McClellan oscillators, as well as summation indexes, are positive. parabolic SAR is positive. The bullish percent index is positive. The Copic curve, that's a new addition to the list. That's a momentum oscillator that has now gone back to looking positive. And the financial sector is still positive, but now the banking ETF is still below its 200-day moving average. The swell trading oscillator continues to go up. That's positive. The ultimate oscillator is just barely above 50. So our conclusion, we're negative in the short and intermediate term. Long term, we're still positive. There are improvements that are trying to come in here. And in the short term, we're negative. We're slightly oversold. We have some things on the list there, but we're seeing some improvements. Momentum is looking better. Some of the short-term indicators are looking better. We just need to see follow through with price. In the intermediate term, it's also negative, but we're seeing some of our intermediate term indicators show a little bit of improvement there. And we continue to be positive because of the trend. Still working off of this golden cross with the S&P, but we're below the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.